So in 2008, obviously you had this increase in volatility in the first half of the year, sort of indecision in the middle, and then this crescendo of volatility at the end, which CTAs just do magnificently in, because they catch the trends. They can be short equities, they can get short the dollar, they can be very reactive and participate in markets that long-only strategies don't. Now, going on to 2009 and 2010, for us specifically, we'd been on a 70% run in 14 months in our program. So we had to give some back. Nobody can sustain that kind of return. So that also happened because many of the trends that were in place changed. Volatility itself declined, and as a result, some of the moves were muted. Some of our shorter-term programs had difficulty, and frankly, where we had the most difficulty was in European fixed income, because there was a battle there between the ECB mandate of being vigilant inflation fighters versus what the markets were saying, which was, we've got troubles beyond inflation, something has to be done. As you go now into 2011, this has been a good time for us, because the pieces that we put in place in 09 and 10 are sort of midstream, and they can react as they're supposed to, as opposed to being in the latter stages of a trade. And those trades are helping us in this environment. Also, the fact that we're so heavily weighted in global fixed income. Our fixed, the yields have gone down dramatically. There's been a huge rally in bonds, so that strategy's helped us. In addition, we have big yield curve positions, so these new curves that we added, the flattening that's going on in global yield curves, is something that's playing to our strengths. And additionally, our short-term trading, our convexity trading, which has to do with very volatile intraday moves. So all of those things are playing in our favor. That's what we do, and this is the space that we're in, so it works well. Well, we approach it in multiple ways. Every day we readjust our position sizes to react to whatever the volatility is, so that if you're trading $100 oil in a low volatility environment, then your risk is lower than if it were in a high volatility environment. We do that with all of our contracts. So the issues otherwise with volatility, however, can be much more complex. Volatilities have regimes in which they suddenly spike or decline. Typically, the way volatility behaves is it spikes, it moves up rapidly and declines slowly. And so the rapid increase can be problematic for CTAs, because suddenly, even with their decay function, even with their daily volatility adjusting, volatility spikes so quickly, so rapidly that their positions are much larger than they should be, and their daily swings are much out of line with their targets. Finally, what we do additionally is we'll actually look at the forward volatility curve, and we'll anticipate what volatility will be, and every hour we'll actually resize our portfolio if our anticipated portfolio is over its skis or under its skis, meaning that if our target, based upon the expected markets that we trade and expected volatility, is much higher than what we intend to do, we will cut our positions. There has to be a minimum move that happens for us to do that. Like, we just don't do it for just marginal moves, but it has to be significant, otherwise we'd be just trading our portfolio too much. Is really getting to critical mass in terms of assets under management. If you look at the variables that define the longevity of a CTA, if you looked at performance, if you looked at regulatory issues, if you looked at assets under management, you looked at history of management team, the variable with the greatest correlation to the success of a CTA is AUM. Now that's circular, because if you're out of business, your AUM is zero. But that really, the AUM, the ability to have a large enough asset base, is what gives you the fees to stay in business during the difficult times. I mean, CTAs do not trade arbitrage. CTAs take risk. Over time they make money and do extraordinarily well. They can go through drawdown periods. And if you don't have a diverse and loyal asset base, that client base that understands what you do, how you do it, and if you haven't communicated that properly and they understand it, well then your business is going to be challenged. I mean, they're looking for an institutional caliber money management firm that runs this strategy. I mean, that is the challenge. And they're looking for a firm that is audited, that has smooth running operations, that has a strong and dependable back office, that has, from the investment side, has a consistent philosophy, a consistent process. I think the industry has to focus very hard on taking away the image of itself as a black box, as a secretive black box world with a different language and a different methodology that it keeps to itself. I mean, the industry has to be more forthcoming about what it does, and it has to be more forthcoming and understand how it performs. I mean, that's the key. You need to make your investor know what to anticipate. An investor knows if it buys a long-only stock portfolio, if it's growth or if it's small cap or it's value, it has a sense of what that does. Well, it was originally called Xenon Capital, and that came because I really like cars, and the best cars have by Xenon headlights. And so in my not such good marketing thinking, or just my own thoughts, that was a new way of lighting up the financial landscape. Now, my marketing people say I'm never supposed to say that because it sounds as hokey as it probably is. So that's where Xenon came from. And then in 2008, we were acquired by Old Mutual US as part of their 2100 Capital Group, we became 2100 Xenon. And I noticed that with a number in front, our returns were always at the top of the list. So I kept the number there. So I've got the number there, which keeps us near the top, and I've got, my love for cars prominently displayed in the name. So that's what it is.